All right. Now we should be in good shape. I believe you can see my screen. I believe you can see me. I believe that you can hear me. And I know it's a good day to be doing this presentation. Okay, great. See if I can just. Just trying to get this to be set up so that I can see what's going on. All right. Well, welcome everyone. Thank you very much for coming out tonight. I am super excited to be able to share these three secret tactics that generate consistent profits while minimizing your risk. Now, in order for me to do that, I'm going to show you how elite asset managers and hedge funds make consistent money in any market conditions. I'm also going to show you three strategies that can transform your trading results as quickly as today. I mean, you're going to be able to apply these tomorrow. And I'm also going to show you why most retail traders fail and how you can join the 10% who don't. Now, according to studies, up to 90% of retail traders lose money in the markets. But here's what's shocking. You see, it's not because the market is rigged against you. It's because you just haven't been taught the real rules of the game. What I'm about to share with you comes directly from my experience as an independent floor trader, where I traded with and against some of the biggest players that are actually moving markets. But by the end of this masterclass, you'll understand these three secret investing tactics that I believe could completely transform your trading results as soon as tomorrow. Now, I call these three active investing secrets the wealth paradox, the signal of the year, and the 30-minute blueprint. But before we get into those, have you ever wondered why some traders consistently make money regardless of market conditions, while others seem to struggle month after month? Well, type yes in the chat if you've ever asked yourself this question. So give me a yes if you have seen or experienced that some segment of traders seem to consistently make money, while others, maybe you, are just constantly struggling. All right. So if you'd like to find a way to get out from that struggling, then you are absolutely in the right place. Great. Thanks. I love the participation. Makes it better for you, better for me. Truth is, most people are struggling most of the time, but it doesn't have to be that way. Before we get started into how we're going to get out of that, I just want to celebrate a few of our members who have recently implemented some of the strategies that I'm about to share with you. So, Liz wrote, I personally have experienced several aha moments during the training. My gains and ease of acquisition have made me a believer. Keith wrote, I'm certain that with the knowledge that you are sharing and proper screen time, I'll be able to completely profitable and ultimately become a professional trader. Thanks again. And Chris wrote, I love your analysis, systems, and expertise. I feel so grateful to have stumbled upon MarketGauge when I did and plan on being a member as long as I trade since you keep me on the correct side of the market with confidence. And I want you to remember that word confidence. Now, give me a wow in the chat if you'd like to see results like this in your own trading. Just give me a wow if that sounds good. And confidence, you're going to hear that word a lot in this presentation. In part because I believe that when you're confident, you'll be a much better, consistent trader, and it's a lot more fun. All right, so for those of you who are new to MarketGauge, I'm Jeff Bish, co-founder of marketgauge.com. I started in my career as an independent floor trader, trading with and against some of the biggest players in the markets on the floor. And for over 35 years, I've been in the trenches and watching how institutional money really moves the markets. And I've been trading strategies for Millennium Partners, which is one of the most successful hedge funds on the planet still today. I've trained thousands of individual investors, hundreds of which have gone on to manage significant amounts of money. And then in 1997, along with my partners, Keith Schneider, who's our CEO, and Ms. Schneider, who's our Director of Trading Research, Chief Strategist, we founded marketgauge. Now, we did this with a simple mission to give serious traders institutional level tools and strategies. And these were previously unavailable to retail traders. Since then, we've helped thousands of traders and major names in finance transform their bottom line using our proprietary indicators and mentorship programs. Our insights have been featured in Barron's, Stocks and Commodities, The Money Show, and multiple different major market outlooks or outlets. And our teams on of market gauge commentaries have been on CNBC, Fox Business, Real Vision, and many others. Now, what you're going to learn here is not theoretical. All right. These are battle tested strategies used by hedge funds, asset managements, and managers, and us daily. These are the same strategies that we've refined through the decades of using actual market experience. So why am I choosing these strategies to show you today? Well, it's important for you to know about them sooner rather than later. And the reason for that is because the markets have never been more volatile, right? Markets have never been more accessible. And this is creating an unprecedented opportunity. You see, with the rise of mobile trading apps and commission-free trading and AI, more retail traders than ever are entering the market. But unfortunately, most are making the same costly mistakes that have plagued retail traders for generations. Now, in today's uncertain market environment, like inflation, interest rate volatility, geopolitical tensions, this creates a massive opportunity, but only if you understand how the institutions are moving these markets, right? The gap between successful traders and failing traders is widening every day. Most traders, even when their research is spot on, end up buying just as the pros are selling. Maybe you felt it. Let me repeat that. Without an institutional edge, you'll tend to end up buying at the worst possible time, right when the smart money is selling. Now, you don't need to spend or be a mathematical genius or have millions in your trading account in order to implement what I'm about to share. You don't need complex algorithms, you don't need high frequency trading systems, and you definitely don't need an advanced degree. But what you do need is to be able to consistently execute on three critical strategies: the wealth paradox, the signal of the year, and the 30-minute blueprint. So let's start with perhaps the most counterintuitive secret that professional traders understand, one that most retail traders just don't pay attention to. You see, the real path to trading wealth isn't about hitting home runs. It's about avoiding strikeouts. And this completely flips conventional trading wisdom on its head. That's why I call this the wealth paradox, right? It's why professional traders focus primarily on managing losses, not chasing gains. Now, I put together a spreadsheet to illustrate this point. The point is that if you lose 50% of your capital, as demonstrated in this yellow line, you need a 100% return just to break even. And the problem is that the more you lose, the more likely it is that you'll never recover. So, I want to show you this little game. And the idea of this game is to demonstrate how important it is to really understand money management. All right. So, it's a simple game. All we have to do is decide which of these two systems makes more. Now, on the left, I have a system that wins as much as 50%. And on average, it returns 5.3%. On the right, there's a system that consistently wins 3%. And as a result, its average return is 3%. So the question is, which system makes more money? Type 1 in the chat if you think that the system on the left in blue with the higher returns but more volatile and a higher average return of 5.3% is the right one to go with. Type 2 in the chat if the returns of 3% consistently and an average of 3% are the way to go. All right, which one of these is going to make more money? All right, I see the answers. I see your pretty consistent answers. Are we sure that the lower average return is the one everyone's going for? Interesting. Interesting. Any more votes? I know there's more people than there are votes. Which one makes more? All right. Well, I appreciate the participation. And congratulations to everyone who said return number two or system number two. As you can see by the yellow box that highlights how your money would have grown in each account, that making a average of 3% actually makes more money due to the consistent returns than something that averages 5.3% but has more volatile returns. Right? Now, this means that a trader making consistent 10 or 15% gains can dramatically outperform someone who might make 50% gains, but suffers an occasional drawdown of 40 or 50%. Right? So, the best way to make money long term is not to lose money in the first place. All right, so professional traders approach each position with the primary goal of defining and limiting losses. Now, how do they do this? Well, first of all, they never risk more than a small, consistent percentage of their capital on a single trade. Position sizing is their first line of defense. Next is they have stop losses, and these stop losses are based on technical levels, not based on some arbitrary dollar amount or some just predetermined amount that they're willing to lose, right? Now, the other thing that they do is they exit losing trades quickly. That means no emotion. It means no hoping, no wishing, no averaging down. They're also extremely patient with winning positions. They let the profits run. They don't sabotage the winners with early exits. All right, now here's an example of members that have implemented the strategies that I'm about to show you. Lothar wrote to us and said the mentoring sessions provide insight into your market analysis, which is valuable in terms of a top-down approach, especially to start the trading day. Since trading with MarketGauge, my trading has become more disciplined, especially in the area of risk management. You see, this mindset, this shift to a focus on minimizing your losses is so important. In fact, not doing this is the number one reason most traders fail. It's because it's tied to psychology. Think about it this way. By focusing first on preserving your capital, you automatically eliminate the emotional mistakes that can destroy accounts. Think about it. When you're down 30, 40, even 50%, you're going to make more desperate decisions. Right now, but by avoiding these drawdowns, you stay rational. So type 1 in the chat if you've ever experienced an emotional impact or significant trading loss and found yourself making worse trading decisions. In other words, give me a 1 in the chat if you've ever had a negative emotional situation lead to worse trading decisions. Now, I would argue that if you're not typing a 1 in the chat, that would suggest that you're saying this has never happened to you, and that means you're not paying attention. All right? I can't imagine there's anyone out there who can't admit that when you have a big loss or when you have something bad happening, it's just not the time you make the best trading decisions. All right? So, with that in mind, secret one, the wealth paradox, is to first focus on not losing money. And if you do that, your trading results will dramatically improve. And it's not just because of the money. All right. Now, stick around because in a little bit, I'm going to apply what I'm showing you here on live charts with symbols that you give me. But first, let's go to secret number 2. All right. This gives you a specific market signal that you can exploit. All right. It's a proprietary market gauge strategy that gives you an immediate edge in identifying high probability trades. This is a signal that we've observed and verified over decades of market research and in our own trading. So I call this the signal of the year, right? And it's something that most retail traders have never heard of. In fact, most institutional traders had never heard of it. Now, it's based on a simple fact. Did you know that the high and low prices that are established for the most part by institutions in the first trading days of the year can go on to create powerful psychological anchors and price levels that are going to influence trading behavior for months, sometimes the whole year? It's not random. In fact, it's how big money operates and how big money affects and influences the market patterns. Now, on this slide, we're looking at red and green lines, and these lines are what I call the signal of the year. Right now, we're looking at the QQQ, the NASDAQ 100 in 2022. I'm looking at 2022 because leading up to 2022, we had one of the strongest, most consistent bull market years that the market had seen in a long time. Right now, first 10 trading days of the year are indicate the high of the first 10 trading days of the year are indicated by the green line, and the low of the first 10 trading days of the year is indicated by the red line. Now, implementing this strategy is so simple that all you need to do to keep yourself on the right side of the market is to understand that when you're below the red line, you want to have a bearish bias. Now, what we teach as we get more into this is some of the nuances of knowing when you're really broken the line versus just challenging the line. But as I'm going to show you in so many examples and live with examples that you give me, sometimes it's just so straightforward. So here's 2022. Remember, we were just in a really strong bull market. Everybody expected the market to go higher, and it sold off right in the beginning of January. And then it bounced. And with that, we had the low of those first 10 days. Once it got below that low, it sold off again. And when it tried to bounce this time, it couldn't get over the red line. And then it sold off even more. And then it rallied back up and it couldn't get back above the red line. And then it sold off even more, right? So all the way into April, that red line was still significant. I'm going to show you examples later where these lines are significant right now in October, November, all right? Now, we had this ugly bear market, the worst bear market we'd had since 2008, 2009. And then we got to 2023. That's the next slide. So 2023, again, I'm just sticking with the Qs. The market did the opposite. In January, rather than falling, it kind of took off and it paused and then it broke out above the green line. Now remember, above the green line, you want to be bullish. And the pattern was very similar to the bearish pattern the year before. It rallied, but then it pulled back, but it held over the green line and then it took off. Right? You're going to hear this pattern several times in this presentation. Not because I put it in the presentation, but because that has been a very common pattern around the signal of the year. All right? It sets its range, it pulls back, it rests, it breaks the range, it pulls back to test the range, and then it goes. All right? This is a very common pattern when you're trading with ranges, and we're going to see it in several different places. It's not the only pattern, but it's a pattern that you just absolutely should know, right? Wouldn't you agree? This is something that if you were to really figure out how this works, you can use this tomorrow. I'm not saying you need any special indicators. Here's why it works. All right. Major funds are going to establish their positions based on yearly outlooks, right? They establish their positions when they adjust to new environments. And the new year is a new environment, right? Now, these initial positions and an initial surge of buying and opinions, they create this support and resistance levels that we're putting the lines on. Keep in mind, though, those support and resistance levels are defined by the calendar, right? Now, if you break above the line, you're bullish. If you're below it, you're bearish. Why? Because it indicates a shift in sentiment, right? We're going to talk a lot about that shift in sentiment as well. Now, when you understand this and you know what to look for, and again, it's not that complicated. It's like getting a peek into the institutional playbook for the year. So here's exactly how you can use it. First, after the first 10 trading days, just mark the high and the low of the year on your chart. Most of the time, you can figure it out without even putting the lines there. Right? Now, you want to focus on where the market is relative to the high and relative to the low for the rest of the year. Because if it's above the high, then this is an area where institutions are going to tend to be accumulating. On the other hand, if you're below the 10-day low, then this is a situation where institutions are more likely to be selling. And I'm demonstrating this on the index, but it's true on the stocks too. Right? So if all you did was to use these levels as an objective benchmark of when you should be bullish or bearish or cautious or aggressive, your trading will be much easier. Here's an example of Apple. All right. Now, this is an example of Apple looking at it for a couple of years, right? So back here is 2022, and you can see it didn't bounce off the line exactly. But when we were below the red line, you definitely wanted to be in a bearish mode. If you wanted to look for the bounce early, you could be looking for it when you get above the red line. But as soon as you get below that red line, you've got to be thinking bearish. And if you really want to think bullish, you need to wait for it to get over the green line. All right. So with Apple, if you had just waited for it to come over the green line, you would have sat out the whole bear market. You would have gotten in near the low of the bear market in the beginning of 2023, and you would have ridden it all the way up all year long, only to get out a little bit into 2024, but then right back in the beginning of 2024 and rode it all the way back, I mean, all the way up to the highs that we're just recently taking out now. And in the beginning of 2025, when the rest of the market went higher, this didn't. Apple was telling you in February that it had a problem. And if you were looking for an excuse to lighten up, or not be bullish, this was your reason. And if you were worried about how to protect your Apple position or not get caught in Apple at the wrong time, as soon as it broke the red line here, it totally fell apart. And it did not recover for a long time into 2025. It's doing great now, especially today, but we'll take a look later at how these lines played out and what they told you about trading Apple. Probably one of the more frustrating stocks of the year until recently. So here are what some of our members have said after using our strategies. John D wrote, "I really enjoy your mentoring sessions and always get something useful out of each one. Thank you for everyone, and I really am glad I met you." Andrew F. wrote, "Showing me how to frame a trade using the market gauge systems was a masterclass in how to create reliable trading processes. You show how to keep it simple. I've developed confidence and success in my trading utilizing market gauge." Now, I love keeping it simple. I love enabling people to feel more confident in their trading. So you're going to hear that a lot. And I love the mentoring part of this. So Steve S. wrote, "I like hearing your logic, your thought process of how you go through your process of selecting trades, setting targets, stops, etc. It reinforces what I've learned from you, and it gives me confidence in my process." And Dean, I thank you very much for your remarks in the chat right now. It's a pleasure. It's a pleasure working with you as well. All right. So My question right now is why would you waste your time trading stocks that are stuck between these levels when you can focus on ones that are clearly at levels where you're going to find institutional interest and institutional disinterest? I don't like to, all right? Just using this simple, vague, or just using this observation takes the idea of vague market timing and turns it into a mechanical, rules-based process. And when you have a rules-based process, it eliminates the guesswork. And that's what leads to the confidence, right? A lot of what you're going to hear from me now and whenever I am showing people how to look at the market is always trying to make things systematic and simple. So give me a two in the chat if you can immediately see how having this very straightforward pattern could improve your trade selection process, right? Again, I told you you'd be able to use this tomorrow, and it's going to get even better because I'm showing you January, and there's one that's more recent. All right. So I'm gonna do this with examples that you give me in just a minute. But remember, we've got three secrets here. I want to get them all in. So the third institutional edge is one that comes directly from my experience as a floor trader. And this is perhaps the most immediately actionable trading strategy because you can use it every single day. You see, on the trading floor, we didn't have fancy charts or algorithms. And there was this one signal that was so reliable that traders would use it every single day without fail. In fact, it's the first thing that Keith taught me when I started working with him in 1990, and I've used it ever since. All right. You see, professional traders understand that the first 30 minutes of the trading day provides critical information about the likely direction and volatility of the market for the rest of the day. And this is what our third institutional edge is built on, right? This is what's called the 30-minute blueprint. And it's such a powerful edge, right? Here's a secret, and I want you to really think about this. Let this sink in. 50% of the time, the market will make its high or low for the whole day in the first 30 minutes of the trading day. All right. Now, let me say that again. Half the time, one extreme of the day's range will be set in the first 30 minutes. Now, what makes this so powerful, amongst other things, is where do you want to put your stop? I mean, the easiest place to put your stop is outside of the day's range. And now I'm telling you that 50% of the time, that high or low of the day is set in the first 30 minutes of the day. And we have a way to make that percentage even higher. All right. So floor traders rely on this principle before we had charts in the pits, and you didn't have to have computers, right? All you had to do was understand this fundamental insight on how markets work. Now, it's so fundamental that it still works today. The computers haven't gotten rid of this. If anything, they've probably made it even stronger. All right. Why? Because it's human psychology and it's all about institutional order flow. And if you think about it, it's the first 30 minutes, sometimes it's the first 20 minutes. That's where all the excitement and the energy from whatever has been happening overnight is thrown into the market, digested, and then the big players have to decide what they're going to do. All right. So here's how you do it. You just wait for the first 30 minutes and it'll establish a range. Now, mark that high and the low on your charts or in your head, or just use a 30-minute bar. And when the market goes above that 30-minute range, that's when you want to be bullish because this is going to signal that the momentum, the psychology is bullish, right? Now, if you're buying stocks above the 30-minute opening range, those are the ones that should be going up. Likewise, if the stock is below its 30-minute opening range, not only is it going lower, but it tends to be more bearish, right? So if you can use this stop to either set profit targets, set your stop losses, or You can use it to identify when you can buy near what will likely be the low of the day or sell near the high of the day. Now, the way you're going to do that is you're going to learn the difference between a good breakout and a reversal. All right. So I'm going to show you quickly how that doesn't have to be that hard, right? Again, the wealth paradox was all about not losing money, right? By understanding that if you're right, you want to stay with it. If you're wrong, you want to get out of the way pretty quickly. Now, the same thing applies when you're looking at the opening range, all right, or the 30-minute blueprint. Now, we're going to look at more examples of this in real charts, but before we do, here's an example of one particular week. Now, I just picked this week when I started doing this particular webinar. So there was nothing special. I didn't go back and look. And in fact, I'm going to just pick this week and last week when we go to do this live. And what you'll see is that when we got over the high of the opening range here with some good momentum, it tended to be an up move after that. All right. Now here it looked like it was going to roll over, but then it broke out again. And what happened? It pulled back, it tested the level, and it went higher. The next day, it gapped higher. Oh, wait. It gapped higher this day too. It gapped higher on the second day. In this case, it broke out. It didn't even look back, just kept going higher and higher. Third day, gapped higher again. All right. 3 days it gapped higher. 2 days it continued to move higher, the days that it broke above the opening range. This day, it didn't break above the opening range. In fact, after going higher for just 10 more minutes, it did nothing but go down. One of the things that we learn in the mentoring is how do you know it's going down? I know that sounds kind of silly, but one simple rule is it trading above the prior bar's high? And if you look at this, no, since the high, really didn't. And then it broke the opening range low and kept going down. And when it tried to come back above it, it just went back down and went back down even further. All right. Now the fourth day, gapped higher again. What are you going to do with a gap higher? Well, I don't know. The last 2 out of 3 days went up. But this one came down, established a range. Once it got through it, it went down, tried to get back up above it, but then went down even more. And then it couldn't get back up above it. My point here is that every day that it took out the range, if you played it in the direction of that breakout, you were on the right side of the market. Now, you're not always, it's not always going to trend that easily, but what you'll learn, and we'll talk about it coming up, is that there's certain patterns that indicate a reversal, right? And when you see a reversal, then it's a different. This happened to be a week where everything was just following through. So when you understand how to use this approach, you're going to have clear entries based on breakouts or breakdowns, or as I said, reversals. And you're also going to have objective stop levels. And these can be as simple as just having them be outside of the range. And you're always going to have a way of avoiding getting caught on the wrong side of a big trend day or understanding how not to get caught in choppy range bound markets, right? In the end, you're getting this mechanical rule that can remove emotion from your trading decisions, and it doesn't have to be complicated. So here's an example of what we've heard from people who have applied this. Jayton wrote, I don't have enough words to thank you all thank you and all your team. You have such a brilliant trading program and methodology. I truly have found the holy grail of trading. All right. Now, the holy grail of trading is absolutely not some secret strategy, right? It's understanding the market. Mike N wrote, thank you. This has made a huge difference in my trading. I can't tell you how much my confidence has increased. Awesome. I love it. Type 3 in the chat if you can see how this 30-minute blueprint could immediately improve your trading results. And in fact, give me a 4 in the chat if you can see how the 30-minute blueprint and the signal of the year are the same concept, so that once you understand one, you understand both of them. And when you understand both of them, it means you have a big picture approach and you have a very specific and targeted approach with the 30-minute opening range. So you put these two things together, and that's why I'm saying you can really improve your trading results as quickly as tomorrow just by getting started with these simple approaches. 30-minute blueprint, which gives you a mechanical, rules-based approach to timing your entries and exits with precision, and it gives you a way to learn how to trade ranges every single day. Those same tactics and techniques can be used on the big picture. So you get, even if you don't want to day trade, don't day trade. Just look at that 30-minute opening range, learn how to trade the ranges. You won't be alone because we're here. And then you'll be able to apply everything you learn there to that signal of the year. And that's where you get the huge moves because you're not playing for what's happening intraday. You're playing what's going to happen for days, weeks, even months. All right. When you understand how to trade a range, when you understand how to trade this 30-minute blueprint, it's like having X-ray vision or a roadmap for what the market's likely to do. All right. So in a few minutes, I'm going to show you how this works on live charts that you select. But first, I want you to imagine combining all three of these institutional edges into a complete trading system. You see, with the wealth paradox, you protect your capital by focusing first on defining and limiting your losses. Then the signal of the year gives you that big picture, the high probability trades that the market is anchoring on right from the beginning of the year, but applies all the way to the end of the year. And then with the 30-minute blueprint, you're leveraging that same skill set, but you're doing it with precise entries and exits on intraday price action. And if you don't want to sit and watch the markets all day, you don't have to. You'll know where to put your stops and put your entries and your exits right after that 30-minute range is formed. Put all these three things together, and you've got a powerful, repeatable framework. And it works across all market conditions, and it works in virtually every market. All right. So when you combine all three of these edges, you get superior trade selection because you're focusing only on the stocks that have the institutional interest in the direction that you're looking. And then you have precise timing because you are looking at intraday price action to establish the best times to enter or exit the markets. And you've got good risk management because you've got a rules-based approach to keeping your losses small and manageable. Now, when you have all this, you have psychological stability, and that is the power of following a methodical approach to the market. It helps manage and even eliminate the emotional side of trading that you just don't want to have to compete with. So now let's take a look at how you can do this in your own trading. All right. Unscripted, I'm going to ask you for examples of symbols, and let's take a look at them. Now, I have to be careful. I'm looking at the clock. I see it's 8:45, even a little later. I got a late start because I was hanging out in the wrong place. And I could talk about this all night long. All right. So I'm not going to do that to you. We have a Q&A. We could do a little more in Q&A, but I'm going to start by showing you the current market. All right, let's just take a look at the SPYs. You guys put the symbols in. We're going to look at those. But I just want to demonstrate again, this is just no cherry picking stocks or specific situation. This is just what has happened this year. I want you to imagine this year if you had, just spent maybe a little more time on this particular pattern structure, and how it would have helped. So here are the SPYs. If you remember, a lot has happened this year. We got off to a little rocky start right after the market opened. I mean, right after the year opened. But we set our 10-day low, and then it looked like we were going to go higher. We were trading over the signal of the year high. And anytime you come back into that, I want to be cautious. Now, beginning of the year, every time we opened into it, we kept rallying up. So I knew that I was going to want to be cautious if we broke down below the low of this consolidation, and I knew that I wanted to be bullish if it went higher. So yep, I was bullish up here for sure. And then as it broke down here, I got bearish. And then when it broke the red line, just as I told you a few minutes ago, really bearish. Right? I even put out an article in our weekly outlook that said this is bearish, and if we stretch back through this low, it's really bearish. Right? That's the same thing I told you a few minutes ago. It's the same pattern, right? We broke down, we tried to get back in, and then we went a lot lower. That's just what markets do when they're trading around a range in a way that is predictable. All right. And when they're not doing that, then you know that this isn't normal and predictable action around a range, and you don't try to participate or predict or anticipate, I should say. So look what happens when you come back into the range. Now, we haven't talked about that because this is a webinar and I don't have all night. But we came back into the range and we got fairly significantly into the range. So you can start to get optimistic here. And then when it pulls back and can't get through the level and then starts to rally, now you know that things have changed. And then when it spends some time consolidating at that level that you be expecting it would consolidate and then breaks out, and not only breaks out of this, but breaks out a new high for the year, all right, you can be bullish now until when? Until it comes back down under here, right? That's just a simple rule, right? So I have to be bearish down all down here, and maybe I'm bearish as it's coming up. I wasn't, but you absolutely could have been. And if you were bearish all the way until it got back here, look, you didn't get crushed on the way down, and you were able to get right back in where the market left off, and you didn't have to, spend the first 5 months of the year eating way too many Malox or some other stress reducing anti-acid type mitigation. All right. It just has kept going and going. Now you're probably wondering, well, what are we going to do with it all the way up here? All right. January is so far away. We'll get to that. Let's talk about the 30-minute blueprint. Again, I just want to start with whatever the market throws at me right now. This is the last couple days. Let's just start at the beginning, um, just so that I'm not cherry picking. So here's the first day. I mean, do it with me with it in your head, right? Oh shoot. Ah, always do this. Putting it on the wrong screen. Thanks. I should have been looking at the. All right. Well, you heard me say it, so it's easier to do it the second time. All right. This is the SPY. I was just talking about it. We got off to a weak start in the beginning of 2025, right here. And at first, the market breaks out of the high of the signal of the year, or what we call the January range. You should all see the charts now, right? Apologize for that. And it couldn't really get going, right? It broke out, it pulled back, and then couldn't get going. But it wouldn't break down below the uh, the range either. Every time it broke down, it would rally right back up. So I knew if we got below these lows, I would have to start to get bearish. All right. Now, I was bullish up here. I thought we were going to break out. We never really got going, but I thought we were going to break out. All right. But I knew that I was going to turn bearish or cautious if we started to break down here. So, yeah, I had to risk this. Okay. I'm not always going to be right. I'm just going to let the market do what the market's going to do. And I also knew that if we got down below this red line, it was going to be a problem. All right. And sure enough, when we broke the red line, it dropped and then it bounced. And when it bounced, it couldn't get back through the red line. So even if I wanted to be bullish, I really couldn't be bullish based on this signal of the year. And then when it made a new low and that was the second leg down, that's where it gets ugly. All right. Same pattern that I've been pointing out this whole presentation. All right. Again, I didn't not looking for a chart where it might work. This was just what happened in 2025. All right. Now you have all this mess that goes on down here. And you know that if we get back up through this red line, things might be turning around. And we got up and we really got through it, right? It's not like here where we didn't really get through it. You're not sure, right? Here we really got through it. And if you weren't sure if we'd have turned around, it came back and it tested the line. And then it started going up again. Now you know it's tested the line. And I can be bullish now until we get back below that red line. Or I could wait till we break out above the green line. And the breakout above the green line was beautiful. It consolidated, then it broke out, then it kept going, then it took out the high. So as it's going up here, just like I was bullish here, I could be really bullish here. And just like I could be cautious here, I could just say I'll be cautious when we get back here. And it just kept going and going and going. Now this is why it's important to understand how that wealth paradox and managing your positions work, because you're not going to know. You just know how to manage your risk. All right. Now, before I jump to the stocks that you were putting in there, and now that you can see the screen, let's look at the 5-minute charts instead of daily charts. And now we're looking at a 30-minute range, not the 10-day range. And I'm just going to start from the first day on the chart. All right. In this particular day, it looks like we opened pretty much unchanged, went down a little, consolidated after the first 30 minutes. Here is the high is green line, the low is the red line. And look at the pattern. It breaks down and it continues. And I have a pattern that I teach called the close and continue, which means that you close below or above the level and then you continue. And there's more specific rules than that, but it's not that much, it's not that complicated. So this is clearly closing and continuing. And then when it rallies back up, it can't get through. And then it goes down even further. And then it tries to rally again. And then it goes down even further. Like that's the pattern. So when you see that pattern happening and you know to look out for that pattern, it becomes something that makes you more confident. And you understand the market's doing what you understand it to likely do next. That's the power. That's why we hear so many people that I'm reading say, thanks for giving me the confidence, right? So the very next day, it's almost completely the opposite. This is why the market drives people crazy, but it doesn't need to. See, in this case, we opened almost unchanged and we rallied up and then we consolidated for a while and then we broke out and we followed through a little bit. Then we pulled back and then we went even higher, right? So look, I don't know if you come in every day and say, I don't know what this market's going to do, but I'm going to let it tell me, right? Now, it's not always a big winner. So here, consolidated, gapped higher, consolidated, tried to break out, but really couldn't get going, really didn't roll over and fall apart. So yeah, you could have easily been bullish in all this and you didn't get a big run, right? I mean, you shouldn't really be surprised after such a big gap higher, but what you weren't doing is expecting the market to completely fall apart. And if you thought the market was going to fall apart, you could have just waited for it to break the red line, right? Next day, gaps higher. And what does it do? Consolidates, breaks out, not really going, not really going, tries, pulls back. When it pulls back, can't get below the green line, and it goes higher and then higher and higher and higher, right? Same pattern, right? Now, I haven't talked about the reversals because we haven't had any real obvious ones, but here's a nice one. Now we're gapping higher for the third day in a row, and we establish a low of the opening range, and then we test it, try to go through it, can't, and we reverse. And in this case, we reverse, and you could put a stop below low of the day, right? Now, this would have looked like a reversal on the high side, and if you played it that way, you would have to say, nope, I'm wrong as it's breaking out to new highs, right? This would have looked like a reversal on the long side going to go down. And if it started to break out, you would have had to cover. But whether you did or you didn't at the end of the day, hard to tell because it didn't really make a new high. All right. There was no reason to believe this was ever going to reverse, right? So sometimes there are certain patterns, like here, you might believe this is going to reverse and it really doesn't. And then this is a Fed day, though. You got to watch out for Fed days, right? But that's more complicated. And then what happened on this day? Never couldn't really get going. All right. So, like I said, I guess why am I not seeing? Oh, sorry. Oh, I was going to say I'm not seeing the whole day. I don't know why I'm not. There we go. So here's today. We gap lower And if you wanted to be bullish, right, it never gave you a reason to get really bullish, and it never gave you a reason to try and buy it against the low of the day. It was just a big nothing, right? I talked to someone at the late of the day, and they're like, "Oh my gosh, the market really got killed." I'm like, "Well, it didn't really get killed. It just opened lower and couldn't get going." Um, so I don't know. That's your perspective. Let's look at some individual stocks. But actually, before we do that, we're gonna do one more thing. All right. Everything I just taught you about January applies to July. Now, if we had more time, could teach you a whole course on why July and January do the same thing, but we don't have that time, and fortunately, you don't need it. All right, all you have to do is know that here's July of this year, and you take the first 10 trading days of July, and those are your levels, right? And if you look at this again, this is a SPY. We broke out of the SPY. We pulled back, tried to reverse. I mean, tried to break down and couldn't. One day down, immediately went back up, and then it's been above that level the whole time, right? Now, I don't know if you can remember back to July, but I remember because this is what happens every time we have a strong market going into July. Everybody's looking for it. It has to roll over. It has to roll over. First of all, July is the worst month to be looking for a down month, but that's a whole other story. All right. But if you think the market's going to go down in July after the market's higher, well, just wait until it breaks the July low. And when it does that, then you can be as bearish as you want. Until that, I wouldn't recommend it. All right. It's not that difficult. It's a great rule of thumb. And let's just take a look at a couple of other Julys. Right? Here's July 2024. Now, in this case, the 10-day level nailed it. I don't say that the 10-day is always going to be the high or always going to be the low. That's not the point. But once you get 7 days into the month, if you've been trading in a particular direction, it's time to start looking for a reversal. Doesn't mean it's going to go down below the range, but watch out. All right. Now, what happened? Couldn't get through, couldn't go any further after 10 days, bounced off the low, but then when it went through it, just completely fell apart. Right? Now, in fairness, it's not falling apart because it's going through that level necessarily, but the fact that it is going through that level is going to tell you that this market is really weak. All right. And then look at how those levels, it played pong between those levels. And then once it broke out, and then it did the same thing. It pulled back, it couldn't go lower, made a new high, and headed higher. And then, just like in 2022 on the way down, but in reverse, it came back again, not quite, and then went higher, right? So there are patterns, like I'm highlighting this one pattern, and there are reversal patterns. When you understand how these reversal and breakout patterns work around these levels, you'll be able to read the market. And again, the reason this works is because these aren't random levels. These are levels at which the market has historically established a psychological anchor. And some days it's an important one, and some days it's not. When you understand how to read the patterns, you'll know when it's likely to work and when it's just not the right day for it. All right, let's look at some stocks. And now, rather than look at January, I'm going to look at July. And July is particularly, and I'm not going to spend a lot of time, I'm not going to spend time on the intraday stuff because I think it's probably more helpful for bigger picture trades to look at the daily charts. All right. Now I saw GDX in there up before there were no charts. Wow. Everybody was really paying attention here. That's great to see. Um, I should start off with no charts. Look at all this feedback. All right, GDX. Actually, I might do that next time. Don't tempt me. Oh man, I shouldn't have started with this. This is mean, right? Because people were waiting for GDX to move for the longest time, right? And July came around, and we have the July range rule. Now, in this case, when the July range is just below a all-time high like this, I'd wait for this breakout, right? So this pullback here, I'm not surprised. And the breakout, the nuance would be, hey, just roll it up to that the high for the year. Once you broke out, it game over, right? In a good way. MO. It's been a while since I've been looking at an MO chart. Oh, now I know why. Yeah, so we can't help you with the earnings, um, but I can help you with what to look for next, right? So the clean breakout in of the July range and rally higher, that should make sense now, right? I don't think it's a coincidence that this is where it stopped. I would say that if it continues to break down below this July level, then I would expect bad things to continue to happen, right? That's just the way it tends to work. And if we had to use an example, I'd go back here. Now, this isn't the same atmosphere. Like when you have a market that's rallied into July and then it's coming into the end of the year, it really should have a bullish bias if it's above the July low. If it's below the July low and going into the end of the year, you don't, and it's been an up year, that's not the one you want. That is definitely not the one you want. You want the ones that look good, they're making new highs for the year, or they're at least above their July range, because institutions are going to want to own it to say that they owned it, and the ones that they're gonna want to sell are the ones that just are rolling over. All right. They probably still have some profits in them if they're up, but if they're not rallying into the end of the year and they're below that July low, not good generally. All right, VRT. Um, all right, this again, another really good example of um, strong into July, right? But not really at all-time highs. And this was how the July was helpful, because if your July level was all-time highs, versus still stuck under an early 2025 high or 2024 high, they took a lot of them took longer to break out, right? But if you are, again, long over the July high, cautious under it, bearish below the low, it was the right blueprint for this. Right now, if you're way above this July level, this July level isn't necessarily going to help you be precise. Um, Marvel. Yeah, this one's tough. And I'm saying this one's tough because look, it really hasn't had a good July. It hasn't had a good year. Um, Now it's over the July high, so that's a bearish bias. I mean, sorry, a bullish bias. But if we were looking at the January level on this, we're way below it, right? So what I'd like to see, because the market's above its January high and it's above its July high, I don't really want to be in something that is, gotten crushed for the whole year. And maybe it's a little bit better since July, but not much, right? This just hasn't turned around. So from these edges of January and July, yeah, it's not. This is better. This is better than nothing, but the January, the condition relative to the rest of the year, not great. Unless you have a reason to believe that it's going to be one of the stocks that's going to be rescued by a run into the stuff that hasn't worked this year. But that's a whole different play. And I wouldn't use these ranges for that. All right, so Amazon, I'm going to look at both here again with Amazon, um, because Amazon is another one that really has struggled this year. It hasn't really been able to break out of its January high here. I thought it was going to here, and then we had earnings that crushed it, and it couldn't get going. All right, it held here again. Now this is also the 200-day moving average. It held here again, but now what just happened? To today, after market, this thing is up. up around do I have the prices on here? I don't. I think it's up around 250 now with earnings. Now it's up around 250 and it had good guidance. It really surprised the street. And if it continues now it's over January, it's over July. Like it has broken out. Now, this is not part of this conversation for this webinar, but just because it's at 250 doesn't mean it's going to keep going. Now you want to apply your opening range. You're going to want to apply your range relative to the earnings announcement, but it's not stuck anymore as long as it continues to go higher after this breakout, right? If Marvel were to gap up like that we were just looking at, the same amount as Amazon, so it's up like what 5, 8% or something. If MRVL did that, I wouldn't be saying the same thing. It's still in the same, still stuck. But Amazon, let's do this. Amazon's out to new all-time highs. Now you can't see it because this doesn't have overnight data, but if I remember correctly, it's trading 250 or something. So it's broken out. So as long as it stays out and keeps going, this thing could really rally into the end of the year, much like Google really wasn't doing very well this year. This is the weekly chart, right? So if I go back to daily, but here's the perspective. Like Google was stuck in July, it was down here, hadn't made a new high yet, right? But now this thing's it's broken out. The mood has changed. I think, and this is going beyond this webinar. I think Amazon could do the same thing, right? Google finally broke out, and let's look at Google. I know you guys didn't ask about Google, but it's a good example of it just was stuck, right? This thing was stuck under its January level for a long time. In fact, its July level, you can see, was under January. That's not what you want to see, but then it finally broke out of everything. So let's look at Apple, and then we're going to go to ANET because Apple, remember, I was talking about this earlier, where it just never got going. And this too took into August just to get back into July. I mean, into January. And so your July range was down here. But now it's breaking out of everything. It's out of January. Here it is in July, right? This is Apple. Should be doing it together. Yep. So here's your July level. When you broke out of July, that's this, right? Right in here. And then it's like, okay, it's getting back into January. Out of July looks good, but now up and away. Yeah, and this too. I don't know where it's trading right now, but had good earnings and right. These things just keep you on the right side, not just of the day, but of the year, of 6 months, of longer periods. And finally, ANET. I love this one. Um, so um, Again, once when it broke out here, it was breaking out of its January, its whole move for the whole year. And if you were watching July, the July range, it gave you a way to really manage or control your risk, right? Same, it didn't correct back down, but consolidated under, it broke out, consolidated around it, broke out. Again, when you know this level is important, you can put your stop back under that level and let the ones that work run. All right. I told you I could talk too long, and I did. Let's go back. We have to go back to the presentation. All right. Does all that make sense? I hope it makes sense. Hope it makes sense. All right, good. So let's put it all together. Imagine that you can spot these trends using the signal of the year. All right. Can you see how that would help you be on the right side of the market? All right. Can you see how that if you have the wealth paradox frame of mind, you're going to protect your money so that you can stay in the game? All right. Not out of fear, but out of confidence. And if you understand how the price action works around that 30-minute blueprint, can you see how this is going to enable you to be much more precise and confident in your trades? All right. Give me a yes in the chat if you can see how putting all these three things together would help you be more confident, more have more insight in how the market works. And you don't even need any special indicators. Like you could take this and run with it. I can tell you, you'll get better and better as you use it. You'll get better and better when you learn all the patterns around it. But even if you just ran with this, um, this can really help. All right. But is this going to guarantee that you're never going to have a losing trade? No, of course not. Nobody's going to guarantee that. All right. But it will in both cases, this is going to enable you to have a edge that's going to put the odds in your favor. But even with an edge and the odds in your favor, there's still a critical element that's missing that helps people succeed. And so I didn't make up this analogy, but I really like it. It applies, as far as I'm concerned, here perfectly. And what I want you to realize is that even if you have the best strategies, it's still likely that you could struggle. And you shouldn't feel bad about it, right? Because there is a way out. All right. So this analogy is that you can't tell when your tail light is out. Think about it. When you're driving a car, unless you have help, there is no way that you can tell that your tail light's out. And that's not a good thing. All right? You can't see when that's out when you're driving. And as a trader, analogously, you are blind to your own destructive patterns if you don't have external feedback. And don't take it personally. Even professional athletes, in fact, especially professional athletes, like Tiger Woods, he has coaches, and it's not because he doesn't know how to play golf, right? It's about having someone who can help you see what you can't see yourself, right? Every elite athlete has coaches and mentors. And not because they don't know what they're doing or they lack the skill, it's because external perspective is so valuable. All right. So in trading, blind spots might be something like unconsciously avoiding to take profits because you're afraid of missing out trades. All right. Or consistently trading too large on certain setups because you're too confident, right? Or it could be that you just abandon your system during periods of drawdown. Or it could just be letting outside factors like news or social media influence your own trading decisions. All right. At Market Gauge, our mentorship program is intended to provide critical external perspective. We help you identify your blind spots in your trading approach so that you can see what you can't see yourself. All right. We'll provide structured accountability to keep you on track when your emotions could lead you astray. And will help you build the discipline and emotional adaptability that's required for success. Right. We do this by offering real-time feedback on your decision-making process. All right. So here's what one of our members has said about working with me on strategies, even in the volatile markets. Henry wrote, so many great ideas were discussed, and I really appreciate them all, especially during the volatile period that we've been through. Your logic, analysis, patience, and explanation of the technicals helped greatly put everything into perspective. All right. So type light in the chat if you have ever realized that you're making the same mistake repeatedly, but only after it's too late. Like, when does that light bulb go off? Give me a light in the chat room if you've ever noticed that, ah, man, I did it again. Did it again, right? But it's too late, right? That's the kind of insight that you can get by having a mentor, assuming that you use the mentor, all right? So now that you understand these edges, I want to introduce you to our comprehensive solution that helps traders implement these principles consistently. Right. So I've taken 35 years of trading experience and distilled it into a methodology that's low effort, low hassle, and low risk. All right. And I'm going to outline it for you here. All right. It starts by addressing what I see as the biggest struggle that I hear from traders. Right. And it's simple. They're sick and tired of riding the roller coaster of wins and losses. But once you get this systematic way of approaching the market, then you'll have this relief, a relief that comes from steady trading. It's priceless, right? Now, to get that feeling, you first you just need to show up and participate or listen in a live trading room, right? You can watch the replays if you can't get there live, but you just need to experience it. You need somebody to show you how to do it, not just tell you how to do it. All right. Then you can use the insights that I'm giving you on the markets, on the events that are happening, on positions, on chart reading in general, and you're going to make them your own because that's what I'm going to focus on helping you do. How do you make this your own? And when you do that, you'll be able to get more predictable results, right? Because it'll be you doing it, not someone telling you what to do. You'll understand how to do it, and it'll be a huge relief. All right. Now, this is what I call the predictable returns protocol. All right. Watch it being done, absorb it for yourself, do it because you understand it. And then everything will become much more predictable, right? This is the surest path that I know of stress-free trading and more confidence. Now, the second biggest issue that traders tend to have is they just get frustrated, all right, when they hold positions too long, all right, or they miss out on profits because they didn't get in on time. But once you have a system, you're going to go from being frustrated to feeling confident and tasting that success as you see and experience doing trading the right way. All right. You'll see consistency. Right now, to get there, you simply need to be focused on your charts and then apply the framework that enables you to be consistent and disciplined, and it will work wherever. It works wherever because it's based on basic fundamental principles of how markets behave. All right. And when you do that, it becomes simple. I'm always simplifying. All right. So you want simple entries, simple exits, and that will make every trade a lot simpler. Right. And this is what I call the profit lock framework. Right. It's simplifying so that you can lock in the profits and move on to the next. It also is simplified so that you can have the professional investors 100% unshakable confidence every time you make a trading decision because the decision won't be around, am I going to be right or wrong? It will be, I know what I need to do, whether I'm right or wrong on this. All right. Now, the third biggest issue is the one that's the most frustrating to me, which is so many traders are just drowning in a sea of conflicting advice and analysis paralysis. All right. Now, this last system, this third part of the stool, is what gets rid of this noise once and for all. It gives you the calm that you want when you're really clear on what you need to do. Now, it's all about having a well-defined list of stocks that you are going to watch. All right. Now, I'm going to give that to you. I spend hours doing it. We review it almost every day. And then when I show you what to apply to these stocks and you see it happening over and over, that's how it becomes yours, right? I'm not going to tell you what to do. I'm going to show you what to do, right? And when you have this, you'll have a clear, simple, repeatable process that you feel confident in, and that eliminates the noise, right? Doesn't matter what the market is doing because you'll have the confidence to know that it's not a tough market, it's not a bubble, it's not this or that, or all the complaints that is making trading tough, right? Because when you are clear about what you're doing, you know when it's working, you know when it's not, you know what to do next, right? So this is what I call the insider opportunity system. It's how I'll help you get rid of the guesswork, give you the fish to go catch, show you how to catch them, and you won't feel this overwhelm of information, right? Now, what's so important is that the outcome of this is that you're able to be consistent, and that is why I call it the insider opportunity system. So if I put all this together, you've got the predictable returns protocol that makes your trading more steady and predictable. Profit lock framework is what enables you to have simple entries and exits so that you're constantly feeling the rewards of locking in profits. And then the insider opportunity is what kind of cuts through the noise and helps you get the trade ideas that you now will know how to run with. All right. I put all this together and we call it the active investing edge. Combine that with a community of traders who are also committed to making trading dramatically improve their life. And that's what I call this Psycho Edge indicator bundle, right? Everything that I've been talking about here has to do with combining the mental strength and insight of trading with simple rules of just how the behavior of market works. All right. That's why we call the Psycho Edge bundle. I'm not going to turn you into psycho. All right. I'm not psycho. Um, so you're going to get four proprietary indicators, right? These are indicators that help you see what the market wants to do. We call it triple play is one of them, and that includes triple play leadership, and there's triple play volume. Now, normally you would have to spend $1,000 to get the triple play package. You get two, they're 500 each. You have to spend $1,000 to get that. Real motion is a momentum indicator. And so that gives you a different perspective on how the markets are trending or moving. And that too is $1,000 if you go get that by itself. And then the calendar ranges is the course and the understanding of the signal of the year and and the July range. And then there's also individual months ranges, but we didn't talk about that. Now that also would be $1,000. All right. Now, in addition, because you're in this presentation, you're going to get three major bonuses if you'd like to take this to the next level. All right. The first is this weekly momentum report. All right. Now, the weekly momentum report is me, and I'll show you a picture of what it looks like. It's it's me giving you stocks charts and identifying the levels at which I would call an entry zone, a risk exit zone, and then your first profit target. And you'll learn how to use that profit target to either take money off the table or move your stops to let a bigger position run. Point is, you'll get ideas and the places to focus on entering and exits based on a number of different criteria. So I look at the technical factors and earnings and fundamental factors, not in a huge fundamental analyst point of view, but I'm a big believer that if you can find an opportunity where the opportunity is growing and your technicals are strong, that's the best scenario. So whenever we can put all that together, we will. Now, in a technical level, we're going to look at the price patterns, much like I've described here. We're going to look at leadership and leadership both in terms of price action, but also a strong volume trend. All right. And that's just something that indicates that the stock is being accumulated. Right. And then one of the most powerful things is momentum. Are you running into the wind? Are you swimming with the tide, or are you swimming upstream? All right. Now, any one of these factors, if it's strong enough, could put you in a trend that will continue to go higher. But I want to find stuff that has all of these, or four out of the five, or at least three out of the five, and that gives you just stocks that you're just going with the wind at your back. All right. Now the bonus number two is that you're going to get all the resources, the training that would normally be involved in the courses for all those indicators, right? So you're getting a library of courses that are available 24/7 in videos, extra packages, and even scans that will enable you to find plenty of ideas. All right. Now, in this particular program, I'm going to advocate, look, just come, see it being done. This is where you can go read about it, watch it, learn everything, the more stuff, but you don't have to go learn and then to come see how it's done. I want you to just come see how it's done in the live environment. All right. Like I've been saying, I want to show you how to do it, not just tell you how to do it and then offer help, right? So you're going to see all this done in the active investing edge. All right. So you're going to see it live in the markets, and you're going to get not 3 months, but an entire year. All right. So join me from 9 to 10:30 every day in the markets for an entire year, not 3 months. And this is how you're going to be able to not just learn how to do it, but really do it. All right. It's just so much easier when you can see somebody doing it. You can ask questions live in the market. You can bring your own stocks that you're following and focus on the things that you really want to focus on. Right. That means you're going to hear about how to adapt to reports that come out, events that come out, earnings reports, Fed reports, days that nothing's really happening in the news, but the markets are really moving. All right. It's a constant Q&A if you want to take advantage of it. All right. Or you can just sit back and take it all in. All right. I'll do real trades and we'll do walk through trades that you may want to look at, and we'll walk through hypothetical trades so that we're always looking at trades. All right. So if I were to summarize all this, you're going to get the four Psycho Edge indicators. Now, normally you'd have to spend $3,000 to get those. You're going to get the weekly opportunity report, which is the only place you can get that is here. And if we were to sell that on its own, it would be $1,000 a year. And you're going to get the recordings and trainings of all the indicators, which to say that's $997 is extremely generous since every one of them usually were $997 or higher each one. And you're going to get 12 months of live in the market mentoring, right? Now, that would all add up to, even at those conservative valuations, almost $7,000, $6,991, right? But I'm not going to ask for $6,991 today, right? Because right now, we're still in the charter membership phase of this Active Investor Edge program. So you can be a member of this for an entire year for just $19.97. Right. All you need to do is go to marketgauge.com/active, and you'll be able to sign right up. Now, the other thing you can do is if you want to talk to someone, if you want to talk to Rob Quinn, he's been working with us for 15 years. He understands all our products, and he trades himself. Give him a call at 407-770-7637. Now, that's his cell phone, so I know it's getting late for some people. You can just text it and say, hey, let's talk tomorrow. Or you can go to marketgauge.com/call, and you can pick a date and time and arrange that in a Calendly like situation. I said I would show you what it looks like, the report. So I just went right into the website here. So here's opportunity report, and then I went into how to read the report. To get it, you'll just come in here, get all the opportunities there. But here's just a description. Let me blow this up a little. Um, the charts look like this, and you'll get, I don't know, anywhere between 10 and 20 of them. And we go over these in the mentoring. and there's breakdowns on the chart. The blue sections are the inflection points where we'll be looking for entries. The red section is telling you, well, this is where you need to start to either be bearish or be reducing your risk or stopping out. Now, bearish doesn't mean short. Just means if you're a buyer at this level, it's not working here. But if it continues to go down, here's another buy zone area. Now, here's your target. And the reason that you would have the target is because, like I said, if you buy it in here and it gets the target, that's the point where you want to start thinking about tactically. You either want to take something off, lock in some profits, or move up your stops, depending on, the objective of your trade. Now, over here on the right, there'll be a little description of what the company does. They'll also tell you when the earnings are due, what the average true range is, because we use that to figure out risk and profit targets. And when appropriate, there'll be some notes on why it looks good and specifics on where the targets are. And if there's additional notes, they would be here. This is meant to be a quick read, and really between the colored areas and the more specific price levels here, once you know how to use these charts, you'll be able to flip through these on a couple seconds on each and say, yeah, it's in the buy zone. Ah, it looks like it's about to get stopped out. Oh, it's taking a profit. And this is all based on how in the room we will be sizing up trades. All right. So it really is intended to be like a cheat sheet, fast jump start, and then easy crutch for finding great trading ideas. All right. And a way for me as a mentor to continue to follow lots of different ideas for anybody that wants to put any of them in their portfolio or just learn from them. All right. So I would say let's open it up to Q&A because I am at the end of my presentation, at the end of my time limit for sure. Are there any questions? Great question. The indicators work on TradeStation, Thinkorswim, Wealth Charts has most of them. Um, stock charts. If stock charts, you don't have to put them in. You just tell us and we'll call them. Trading View. I should have the list. I should have the list in front of me, but I don't. Ninja has some, um, not all of them. Um, there's a couple other TradeStation related ones. Does anyone have a platform that I haven't mentioned? Um, Thinkorswim definitely works on Thinkorswim. Yeah, I don't have the list. Let me do this. Let me see if we put it. Oh, we didn't. Um, So the opportunity report is what I was just showing. This is a blow up of what a chart looks like, right? And then it's all you do is you flip through the chart. Oh, geez, I did it again. Ah, I've got this thing showing the different screen. So this is what the chart. Thanks a lot, Tim. Knucklehead. All right, so this is what the chart looks like. This is what I was describing before. And so the blue zone is where I would say the inflection point is that is the buy zone. Now, sometimes that's going to be looking for a breakout, like this is looking for it to move higher, buy through the zone. The red is it's not working. That's where you're going to start looking to get out to protect your capital. Now, in this particular chart, I also have a buy zone down here, so that if we never really entered in this buy zone and we just went straight straight through this, there's no reason. I'm not suggesting you short it there. I'm just saying if you're long, it's not working if you get into the red zone. But if you just go straight down, there's another value area down here or potential buy area down here. So that's just another blue zone. And then the green zone is simply a target area. And the target area again is a reinforcement of where would you want to put your targets to either move up your stops or take some profits. And there's a relationship here between targets um, and risk, which is the red. All right. So that reinforces how to what I described earlier as size up the trade. And then on the left-hand side, this is other information that'll be on most charts, maybe not all of them. Just a quick description. When are the earnings supposed to come out? What's the average true range? Because we use that. Most charts will have that, but the idea is you should have everything you need right here. These are all the indicators. I'm not going to go through and explain how to read them all, but this is what they look like, right? You've got the phases up here with the moving averages, and then this is real motion. This is triple play leadership. This is triple play volume. And the simple interpretation is if you got green dots, it's on the bullish side. If your red line is over your blue line, the faster moving average, that's bullish. And in terms of volume, same thing. If your volume red line is over your blue line, then that's bullish as well. Right. So a lot of times I'm really just starting with stocks that have all the indicators that look good. Now they're not always going to look good, and sometimes the fundamentals are just going to be so strong that you don't need them all. All right. But um, quick description of what the trade's about, and if there's any notes in terms of um, how to look at it better, maybe about the calendar range, which you can see in here too. All right. So that's what now these yellow bubbles don't show up on all the charts, right? Just the other colors. All right, because this is literally the website, right? If you're a member, you're gonna go into Opportunity Report. I just clicked here. Everything that I just said and more is in this welcome video, and then the Opportunity Current Report is right there. All right, and then you just flip through a bunch of charts that look like this. During the week, they get updated. At the end of the week, I'll come up with new ideas. And actually, as soon as I get done with this, I'm going to go update a whole batch. I think I have probably 10 new ideas I'm going to swap out based on recent market activity. All right. Um, Thank you very much, Tim, for letting me know. Um, are there any questions? I know I've gone pretty long, too long. I hope that I have answered all your questions, but I am here to answer any questions. And if you do have any more after this, you can always call Rob as well or send us an email. Um, and yeah, the color dots, Terry, that was a game changer for me too. It just I wish it was as easy as just green or red. It's a little bit more than that, as you know, but it doesn't always have to be, right? If you keep it simple, and also if you've got them all going in the same direction, um, and the color dots that's from my intern. My intern, I asked him why aren't you using more real motion? And then I showed him the color dots. He's like, oh, well, if you make them all colored, I'll use it. I was like, okay. All right. And then I had to agree with him. It's just so much easier. Um, all right. Well, if there aren't any questions, I'm going to let you all call Rob, or just go to marketgauge.com/active. Or if you're already a member, keep your eye on the report. I'd say tomorrow morning, because I don't want you to be up as late as I'll probably be just putting these new ones in. But yeah, especially with earnings season, um, and maybe the market will actually pull back a little here, and it'll be a great opportunity going into November and December. All right, I am really looking forward to the last 2 months of the year, and then I always look forward to January. Now you know why with the signal of the year, and Yeah, I'm also bullish. Even if we sell off 10, 15%, it'll be a gift. So if you'd like to take advantage of this, I would say a market environment of a generation or 20 years. We haven't seen a market like as exciting as this since the 1990s, in my opinion. Not just because everything's going up, but because of the things that are driving it. And so I'm really excited for this product and the service and the report and how AI is helping. And it's off to a great start. It will not remain at this price level. But I'm not going to tell you get it by the end of the week or the price is going up because that's not going to happen. But our objective is not to keep it at this level. So it really is a charter subscription. Thank you, everybody. Thank you, all of you who are here that are regular members. I really appreciate it. Um, and Yeah, I don't have anything else. Um, and Dean, thanks for the nice words. I appreciate it. And I always love to hear when what we're doing is helping because we do it to help. All right. Abdul, thank you very much. Pleasure seeing you. Jerry, great to see you. Hope you are doing well. I know you're doing well. I know you're talking to Keith because I'm part of the MGAM stuff too. Terry, always pleasure. Dean and Tim, awesome. And Rob, um, I don't see all the names, but thank you very much. I'm going to call it a wrap and say bye for now. Hope this was helpful. Clark, you are welcome.